When oil prices collapse but begin to sound out for a bottom, this will often first show up in the futures contracts, usually for summer. It might surprise some people to find that the seasonal low for oil prices is around January, February, and the seasonal high is often in August or September, but it is. That is why the summer months often get bid up in advance when traders speculate that falling oil prices are reaching a bottom. It doesn't mean that they're right, just that there will be a lot of activity around the potential peak before other months get in on the action. Right now, this situation has created a steep contango. So steep that, as you probably know already, tankers have been hired at thousands of dollars per day to store oil which is hedged by selling futures contracts at higher prices and locking in a guaranteed profit, as all costs and income are known in advance. Buy oil at 35, store it for 3 months for, say, $3 a barrel, and sell the futures contracts for someone to buy it from you in 3 months' time for, say, $42. That's over 10% for a 3-month hold and a guaranteed profit. I'd just like to interject here, by the way, that tankers did catch a bid on the back of this, but right now the day rates for tankers are at near all-time lows, and a company like Frontline, FRO, is actually getting less than break-even for their tankers right now. It's a pretty shit market, basically, oil, just now. Anyway, so we've got contango. So who is bidding up the future contracts to create the contango? What do they know? Why are they paying higher prices? Well, actually that might be to look at the situation the wrong way around. Instead of asking who is bidding up the futures, let's look at who is selling the near-term oil price and depressing the near-term oil price to create that contango. This creates contango by lower prices of oil for the near term, which seems odd at first glance, because if they're bidding up the futures contracts for several months out, that would seem bullish. But the answer is, da-da! All those tankers of oil sitting there waiting to be dumped onto the market. A depressant for the near-term price. There's plenty of supply and people can see it. It's visual. It's right in there in the newspapers. Tankers full of oil. Now, months further out expect this glut to ease, so they stay more realistic, whilst the near-term prices collapse. Of course, economic Armageddon isn't helping either, but again, that is for another video. Anyway, contango. It's killing USO and will continue to do so until, wait for it, oh yes, there's a fairy godmother for USO waiting in the wings. Backwardation. B-A-C-K-W-A-R-D-A-T-I-O-N. I don't know where they get these names from, but anyway, backwardation is the opposite of contango. As oil supply looks to be threatened and refineries etc. vie for near-term oil, the price can rise above the price far out futures contracts are trading for. So in other words, people want oil now, and they'll pay more for it than they'll contract for several months out. And this was the case when oil was on its meteoric rise up to $147. Backwardation. Now this, of course, is splendid for USO, and it soars above the oil price to trade at a premium. This is because each rollout, in that case, buys more oil than the previous contract they just sold. So in other words, if the near-term contract they can sell for $40, for example, right now, if they could sell the near-term contract for $40 because Iran are threatening to cut off supplies and I don't know, all these tankers suddenly sink or something. So they pay $40 for it, but the next month out is still 38 or something. You can see that they can sell at 40 and buy at 38, which is ideal for them. So that's USO. Now, for a pretty good proxy to the oil price, there is a fund called DBO, which uses a mix of expiries in the futures market to track oil prices. which tends to even out this contango backwardation situation and give a much better reflection of the actual oil price. I think it's a much better way to track oil directly, and I shall post a comparison of DBO to USO in the more info section to demonstrate periods of contango and backwardation. Is USO a pile of junk then? No, but it will exaggerate the trend in oil prices, so make sure you're on the right side of the trend before looking to buy it long or sell it short. Basically, from last year, rather than short the futures, many traders have shorted USO successfully because it steamed down faster than the oil price did. However, if oil does bottom and make it back up, then the opposite will be true. I hope that was worth your time. Thanks for listening. I may take this video down at some point and put a new one up in its place if I find that there are problems with people understanding what I've said, or there are things that I want to add in. Okay. Thanks very much. Thanks for listening. Hope it was worth your time. Bye.